Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.
Hello, my name is Michael Stoller. So where do we look at 2010? What's going to happen? 2008 was a tough year, 2009 was a tougher year, and where is 2010? So I've assembled this group of gurus. I don't know if they are gurus, but we hope they are. This group of regulars, I really should say, to provide insight to my audience on where they see 2010 in the commercial real estate in New York and around the world. My guests today include Bruce Mosler, the co-chairman and CEO of Cushman & Wakefield, Steve Witkoff, the CEO of the Witkoff Group, Jim Kuhn, president of Newmark Knight Frank, and last but not least, Joe Ficalora, the chairman, president, and CEO of New York Community Bank Corp. So, Joe, you're the banker. These guys are the investors, the brokers. There are other things. 2 years ago, you were on the show, and I said to you, are we in a recession? Before anybody said, we're in a recession, you said, we're in a recession. Are we still in a recession? Where are we now? It's December of 2009.
I'd say that we're still in a recession, and there are some clear indications that certain components of the market are going to improve, but overall unemployment is going to be very difficult for a protracted period, and although we're going to do better in some ways in some markets, we're going to fall back in others. So I think a lot of what has happened in '08 and certainly in '09 will in fact replicate in '10 and maybe even in '11 in some of the markets that we're in. There'll be difficulties, despite the fact that there'll be some, good signs and places where real estate will do better. New York has the benefit of having people from all over the world wanting to invest here.
Sometimes when I do this show with this group of people, we have the optimist, we have the pessimist. So let's ask the pessimist. Mr. Kuhn, where do you have been, I even wrote this article that just came out talking about the pessimist, Stoller, really felt that the office market is improving. Where does Mr. Kuhn, who's basically as pessimistic as I have been in most of my articles and writings, really look at it today?
I think that we tend to be too myopic because you ask the questions and we talk about Midtown Manhattan. So let me answer the question the following way.
We won't get Midtown Manhattan. We're going to get a little more global.
So let me answer the question the following way. I think 2010 has two big question marks. First of all, jobs and corporate America. Until we settle out health reform, financial regulation, and climate control, I think companies are reluctant to spend money. I think that the ones that do, you have to question whether a lot of these jobs we've lost are gone forever for productivity. So you can't paint all companies with the same brush. When Oracle decided to buy Sun Microsystems, they went back to the old vertical integration away from specialty because they want to control materials, they want to control distribution, they want to control manufacturing. So between technology and productivity, a lot of these jobs won't come back. The second question mark for 2010 is financial regulation, and can the Fed and the federal government figure out how mortgagees can get back their properties to go back to an orderly credit market. And we've had 3 cases today that are very dangerous between extended stay, general growth, and the mall in Syracuse.
Extended pretend, not stay.
Right, because in many cases the courts have said, you know, springing guarantees don't matter, SPVs don't matter, you can't give away your rights in bankruptcy. They say the special servicer may not be the only one that can negotiate the structure for the stakeholders. And they said that the bouncing clause in the mortgage may not be effective because they're making the lender fund in pyramid law. So I think that 2010, we have a lot of question marks before we can even determine whether this market's going to turn in 2011.
Mr. Witkoff, I'm not saying if you're the optimist or the pessimist, but you're very positive. Prior to the show, you were really in this great positive mood telling us about Superior Inc. apartments selling at these great prices at Lower Manhattan. You were really optimistic, so?
In that confidential conversation.
Yeah. No, it wasn't confidential on that side. We had other confidential
You know, Mike, I've been.
You can't say anything?
I've been dour. You know, I have been. I've been a little bit negative, but I feel that things are better out there today. I just do. I think people are buying. They're spending their money. Apartments seem to be selling a little bit better in the city of New York. There are lenders like Joe, who are deciding to do construction to do a construction loan. Now it's small and it's incremental, but that's how it starts. And we talked about it earlier. In 1996, 1997, that's exactly what happened. I was buying in 92, 93, and 94, and there were, in my opinion, no signs of any kind of revival in those days. Mm-hmm. And then all of a sudden, you began to see, the signs out there. And the anecdotal evidence is there.
I think, Steve, part of the situation was in 92, 93, and I think Jimmy could bring this up also. You had an RTC where there wasn't this pretend and extend. People went to the RTC, they would sell the property. Now, Joe's not in that situation. Joe's a $33 billion bank, second largest thrift in the country. He's okay, but these other banks, I was at a symposium this morning and somebody said to me, you can't talk to anybody. Let's try to understand. You have a guy who's your partner right now, Ben Marciano from Euro Hypo. Who's around at these German banks? Nobody's talking over here. They got to go to Germany. They got to make a decision. Who's around at FBOP, which was a bank who was very aggressive, taken over recently? It's not the same mechanism as we had in the 90s that the government said, hey, the bank was taken over, let's go into the RTC.
Because the banks in the 90s were bridge banks. They didn't have mark-to-market issues. They closed down the bank on a Friday. They protected the depositors. They got rid of management. They recapitalized, open on Mondays. Then the RTC owned the assets. They could sell them at market. But that's not really the issue because it's not who's around at an individual bank. The problem is solving this issue, the process with the special servicer and the securitization and the stakeholders that are not aligned. That's the real problem. And there's nothing on the horizon to me that indicates that there's anything that's going to solve that logjam.
Mr. Mosley's organization, a couple years ago, Bruce, how much did investment sales of Cushman in New York and nationally have in 2006, 2007? $30 billion of sales, something in that magnitude?
Probably in that range. A pipeline typically in the good years was 18 or 19 billion.
And what do you think this year was?
I would suspect that it was probably 20 or 30% of that. And that's with a business that has the second largest share of the overall marketplace.
And let's look at the sales that took place in New York City this year. I know I'm myopic. I'm sorry. I'm still in New York City. 1540 Broadway, one deal. Worldwide Plaza,
which was let's remember seller finance.
That's what I'm bringing out.
So
seller financing,
yes.
Worldwide Plaza seller financing,
yes.
all the seller financing.
Yes.
Who was doing the other deals? I mean, I haven't seen any acquisitions.
Well,
You've had some properties.
But Michael, let's frame this again around the context of your original question, which was looking forward into 2010, what do we see versus 2009 and where we are? And I want to pick up on a couple of topics that Jimmy rose. First, I think Jimmy's absolutely right. You have to look to employment as being a key indicator. And along those lines, I would say that in terms of the jobs claims, this past month, it was down around 466,000, which represented a low low. And if you follow the trend, our economists think that sometime mid-year next year, you'll begin to see some positive job absorption. Now, that's critical to the future. Also, picking up on another trend that Jimmy brought up, I think that business today, in terms of their expense run rate, is running at all-time lows. Businesses have taken out about all the expense that they can, and most businesses, I speak for us as well, are running at almost a level that's not sustainable in the long run. I think business has to begin to hire again to support its current level, even after right-sizing in a proper fashion, which bodes well for the future. I also think that the leasing market in this city and around the world in the major financial centers, I speak of only those cities for the moment, has capitulated. So asking rents have come off 25%, but we know that the taking rents are down 40 or 45%, and that is driving some demand back in the marketplace. We have seen absolutely no capitulation on the investment sales side in the United States, but not true in Europe. In key financial markets in Europe,
I think
the marketplace
London,
has liquidity, which we don't have here in the U.S., and is showing signs of a strong recovery. And in the U.S., the reason I'm a bit more optimistic, which is not to say that we don't have critical hurdles to overcome. We do in the U.S. But the optimistic lines that I see are that the U.S. dollar continues to be weak, and let's assume that it doesn't fall off the ledge, which I don't think it will. The U.S. dollar is weak, so foreign currency plays very well in key financial marketplaces here in the U.S. And we have seen lines, I think trend lines, that suggest that cap rate adjustment here is going to be somewhere in the 7s and 8s in key financial marketplaces, not in the double digits that some pundits were predicting. And the lack of the mark-to-market, or the easing of the mark-to-market, will probably provide an orderly fashion in which I think you will see at some point great opportunity present itself. Maybe not 10, but in 11.
As opposed to inside baseball, why don't you explain to my audience who don't understand what mark-to-market means?
Well, Joe would probably be much better.
Yeah. Joe, you're the banker on it. What does mark-to-market mean? And then I'll bring up a couple of points.
I think historically, last cycle, which ran from 87 to 92, there was not mark-to-market as it is today written. Mark-to-market as it is written today is an assumption of value every 90 days based upon market conditions as they evolve. Those market conditions, if we're dealing with real estate, are dealing with the values of properties as they trade or otherwise as they can be appraised. If we're dealing with instruments, structured debt instruments, those instruments...
Let's get to real estate. I'm not structured debt instruments. I want to get to real estate.
The important thing is that, that mark-to-market as it exists today is evolving in a direction which will take value out of the market. There has been the Perlmutter Bill amendment explicitly tries to identify the importance of systemic consequence to decisions that are being made by the FASB. The FASB has been extraordinarily instrumental in decapitalization of the financial markets, meaning they erode capital through multiple rules that are very badly designed. Even the people who implement these rules do not agree on what they say. So, for example, 157 mark-to-market has been changed 4 times. Right. Fully informed people look at 133, another rule, and they come to totally different conclusions. The consequence of all this uncertainty is devaluation. Devaluation and instability in the ability of lenders to lend. If lenders don't have capital, they can't lend money.
I think, Michael, the one point that we haven't discussed is why do we care about mark-to-market? Well, but the issue is that when the banks have to mark-to-market, it's a hit against their balance sheet, and they have to raise additional capital and
Agreed.
dilute their
But
shareholders.
under today's condition, they do not have to go to mark to market.
They've been
right,
granted.
right. They've been
Reprieve.
granted
A temporary
Right
reprieve.
now,
A
there's a
reprieve.
temporary
Correct.
reprieve
Correct.
saying that if you're in negotiations with your borrower and you're in discussions with your borrower, you don't have to do mark to market.
And
So
if
they
you're-
are postponing.
the
They
thing
are
is-
Well,
pretending-
but there's some
and extending.
provisos to that, right?
Yeah, there are.
Your loan
and
has
there
to be
and there are lots of
technically
and there are
current,
lots of other
and
rules.
There's some other
Yeah.
provisos.
And the bottom line is, most of the funding of the growth in value did not come from banks. So banks only represented in some
Correct.
markets
Came
30 to
from the
40%.
CMBS market.
So when you look at CMBS not being there, you in fact have taken out of the market funding. Without funding, you can't have appreciation because you
Correct.
can't rebuy an asset at a better price if in fact no one will lend you the money to buy the asset. And the only way assets will trade is down.
And as long as banks can raise equity in the market today, they don't have to worry about selling off their loans.
Wait a second. Can I ask the banker how much equity has been raised this year by? I mean, the major money center banks
The top
are
19
not
banks.
lending.
Yeah.
The major money center banks, Bank of America, my friends, and other people, these people aren't lending. Citibank isn't lending. The community banks, the smaller banks, are lending.
But think about this. It is counterintuitive for a bank to go out and dilute their shareholders, to raise capital by actually losing money. And when in fact the 19 banks were asked to go out and raise capital, they stepped up and said, fine, we will dilute all of our existing shareholders on the premise that we're going to lose all of our earnings, but this will give us enough capital to sustain ourselves over the future period of loss.
I think the Wall Street Journal said today is $1 trillion sitting in the banks.
But I think
talking
we're-
about in
I think,
capital
yeah.
or?
But again, I think just in terms of from a simplistic overview, I think we're missing one aspect of the macro picture, which is that if we operate under the assumption that the banks have been given this reprieve and an easement of the mark-to-market, if only to rebuild their balance sheets, then it also stands to reason that as they rebuild their balance sheets, we will begin to see some of this product re-enter the market. The purpose of this, in simple terms, Joe, I think, was to allow the banks not to have to mark-to-market at the trough.
Right.
And
But
we are going to, in my view, based on what you've seen happening in Europe, in the major financial centers, we're going to see a replication of that at some point over here. As banks rebuild their balance sheets, we're going to see product come back to market. And at, if not peak pricing, because clearly that was driven by high leverage, we're going to see it at pricing in key marketplaces that reflect a much better value proposition.
One
than was
of the
necessarily
realities,
anticipated.
unfortunately, is that a tremendous amount of the outstanding debt is not held by banks.
You are
Is
right.
actually held
It's-
by CMBS
Yes.
at levels that are way beyond the market, which means they're all going to default over time. It takes, well, you mentioned the RTC. When the RTC was dumping assets into the market, everybody was able to step up and buy
Yes.
at discount assets. Right now, a huge component of the marketplace is in default, but it's not available.
Correct.
These properties cannot be
You're right.
sold because it is much longer to unravel CMBSs than it would be to actually dispose of assets held by a bank.
Mr. Witkoff, you're an investor. You have money. You have money from here. You have other investors. What are you doing with your money?
Well, there's not a lot of things to buy today. But I also think that you've got more astute lenders today and more astute bondholders today. The RTC, I mean, we were big RTC buyers back then, Joe. And
Good stuff to buy.
And you could buy because they were dumping.
Right.
But
And we were lending. It was the perfect match.
but remember, you had a government bureaucrat who was selling that stuff. I mean, today, CMBS has been tranched up. You've got very smart people there who say to people like me, come in, put some equity in, let's re-equitize. I don't want to sell this thing at what the market is today because I don't believe that's the market today.
Wanna
And
be
just
a
because
partner.
I'm a lender doesn't mean that I'm going to take it on the chin from you because you call yourself an equity guy.
Well, we also sit here and we talk about why, about buying real estate. Why do you have to buy real estate? If you bought financial institutions, you made 146% since March. If you bought oil, at $38 a barrel and it's 70 something today, why would you buy real estate?
Good point.
Look at all the money that people have invested in REITs this year. Look at $15 billion.
They bought REITs at the bottom of the market when you could buy preferreds or converts at 25% returns.
Not only that, Jimmy, they've also given them money for bonds. I mean, look, Vornado has raised a lot of money. I mean, you're a
but
large
wait a minute,
shareholder.
that's the theory on which people are operating that have bought real estate. Whether it's seller financed or not is irrelevant. People have been buying it roughly in Manhattan. Let's just stay myopic for a moment at $400 a foot on average versus original purchase pricing and between $1,000 and $1,200 a foot. So there's money to be made. It may be more risky.
If you believe that $1,000 or $1,200 foot was a real number to begin with.
If you believe, but regardless of whether you believe it's a real number or not, it's a function of whether you believe today's number is real or not, as against the timing of the turnaround.
Let's go. 2010. Is today's number realistic, or are we going to go
I think
down?
so.
Go down in what context?
Price per foot?
No. I don't think you'll go down because I think, as Steve said before, you have a much more educated environment for the stakeholders today. And they recognize that in markets like New York and Washington, D.C., you are still supply constrained to some extent. And so they're not going to sell, even if the fundamentals deteriorate slightly, you're not going to see Manhattan office buildings sell at cheap numbers, I don't think, in our lifetime.
You don't believe the AIG buildings, which sold downtown, sold at cheap numbers this year?
No, I think they sold based on what the analysis would be if you went in and converted it to residential and you spent $150 a foot and you rented it $40 a foot. You can't say that the Pine Street building is the same as 452 Fifth Avenue. What I'm suggesting is that Class A office buildings are not going to sell for
450.
$250.
There's no 452.
No, there is. Well, that's okay.
I think you're saying 450 Park Avenue?
No, it was Fifth Avenue. 452
Oh,
Fifth
Fifth.
Avenue.
I'm sorry, yes.
Yeah.
What I'm saying is that I don't believe you're going to buy trophy office buildings for $250, $300 a foot. I don't think there's enough of them.
I agree.
I think there's still going to always be a
But
premium.
wait, 452 Fifth Avenue sold for about $330 a foot.
Yeah, and you said, is it going to go down? I said, no.
What's predicating these prices? What's predicating these prices? Steve Woodcoff, you bought some office condominiums this year at about $300 a foot, something like that.
I think people sold because everybody was in selling mode in the last year, Michael, because
So everybody should be in a buying mode in 2010?
But people sold what they could sell. That's what happened in the stock market too. They sold what they could sell, and if you didn't have to sell, you didn't sell. And I think the market is going to come back. Look, at the end of the day, real estate is about supply and demand. That's just the bottom line, and it's about politics in this town. And if people feel that there's good politics, that tax posture is good in this state and in this city, they encourage business to come here, regulation is what it ought to be for business, crime is down, and
Taxes are up.
well, that's the negative. But I mean, if these positives are going on, and on top of
Taxes are
that,
up
there is no
everywhere.
construction money out there, you're going to have a pretty good recovery in the real estate marketplace, which is why you saw real estate stocks rallying to this extent. Problem is that there's nothing cheap out there today.
Well, the problem is there's not enough product. But coming back to a couple of points that were made before, I think we reached the trough in the marketplace, probably in Q1 of this year. Just the absolute trough in terms of the lack of anybody being in a position to move forward. Beginning of this year, we weren't sure if the stimulus package was going to go through. We weren't sure what effect it would take. We weren't sure which financial institutions would be healthy, which would not be. A lot of questions, I think, have been answered in the last 12 months. Not all of them, for sure, but a lot of questions have been answered in terms of the financial stability of the marketplace. The question for 10 is, are we going to begin a recovery or bounce along the bottom? And that's a question that you can answer a variety of different ways based on how you look at the key indicators. I think that the markets, certain markets, will begin a recovery. And I think Manhattan is one of those marketplaces that will begin a recovery in 10. based on a number of things we've said before.
But we don't want to be as myopic, you know, as Mr. Kuhn said. The show is
right.
not only, we have people from around the world who
He's
watch the
absolutely
show.
right.
So let's not go Manhattan myopic. Let's get to, and Manhattan is, there's different sections of Manhattan, and that part of it we'll discuss today and part of it we'll discuss next week. But where do you see certain of the New Jersey? I mean, New Jersey has been the vast wasteland, but you lease some property to Depository Trust, your company, this year.
I can't talk about that.
But I know it was publicly announced that there was property leased in New Jersey. And recently, Starwood signed a major lease and is moving to Stamford.
It's not signed yet, but it's
Pretty close. It was
LOI.
released in the
I
information.
can't talk about that.
Yeah, I would say I don't know. I do know that there's been some commitments made. I don't know the details.
But what's happening? No,
but-
okay,
but-
let me say this: the state of New Jersey and the state of Connecticut are taking advantage of incentives. That's what is stated in the press releases on the Starwood situation. $40 million. The state of New Jersey has come out with a new program earlier this year to maintain companies to move
I
tenants.
think Jersey is going to lose as many jobs to Manhattan as Manhattan loses to Jersey. How do you like that? I think that Wall Street is going to start to hire, and they're going to bring people back from New Jersey. That's my opinion.
Wall Street is no longer in Lower Manhattan. And next week, we will talk a little bit. We're going to get back to myopic. I'm sorry I have to go myopic, but next week we will continue our discussion on what we look at 2010.
Okay, but I said Manhattan. I didn't say just Lower Manhattan.
Okay.
My point, though, is I think that where Bruce, I think, is correct, is I think that we will start to recover, and I think it's going to be from the same reason that we had the hit.
So
I
you
think
follow
Wall
it up
Street-
next week.
Wall Street's going to hire.
Yeah.
I'd like to thank Bruce Mosley, Steve Witkoff, Jim Kuhn, and Joe Ficalora. See you next week for the continuation of our discussion.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.